You've been doing everything right. For 3 years straight, you've diligently saved a portion of every paycheck, maybe $500 a month, and funneled it into a low-cost index fund. You've said no to impulse buys, packed your lunch for work, and dutifully ignored the flashy marketing that screams for your attention. Then you check your investment account expecting to feel like a genius. Instead, the balance reads something like $19,000, enough to almost buy a well-used Honda Civic. It's a deflating, frustrating moment. Meanwhile, a coworker who started 10 years earlier mentions their portfolio grew $47,000 last quarter. They didn't add money. The market did it while they were on vacation. You want to throw your laptop out the window? The beginning doesn't feel like building wealth. It feels like stuffing cash into a slowly deflating mattress. Your net worth crawls forward like a drunk snail. You're not failing. You're experiencing the physics of starting from zero. You are doing 100% of the work. Let's get specific about why the first chunk feels like financial torture. With a small base, market returns are practically useless in the grand scheme. If you have $5,000 invested and the market gains 10%, you made $500. That's dinner, not life-changing money. In the early phase, roughly 7 to 8 years, almost all growth is from your contributions. You're manually shoveling money month after month, year after year. Save $6,000. The market adds $400. Your brain knows you did the work. You see friends leasing luxury cars or buying homes while your account shows $23,000 after years of sacrifice. But you're building the foundation of a machine that will run without you. Foundations are invisible. No one claps for concrete. On average, it takes 7 to 8 years to hit the first $100,000, assuming steady savings, average markets, and no panic selling. 8 years is 2 presidential terms, long enough to forget why you started. But that $100,000 is the activation point. Past that threshold, the equation shifts. Compounding becomes visible. It really is. The pain of the push is the prerequisite for momentum. Once your portfolio crosses $100,000, something profound changes. It's not the world. It's the math of your life. A 10% year is now $10,000. That's a decent used car appearing because the market had a good year. Your contributions still matter, but now they're amplified. Your money starts pulling its weight. The second $100,000 typically takes 5 years, not 8 like the first. The market is now doing visible heavy lifting. It's really picking up steam, and that's real. Compounding shifts from theory to mechanics. At 4 or 500,000, the numbers get staggering. In a strong bull year, you might see 60 to 80,000 in 12 months. Not from saving, from the market. That's the crossover point. Your future is no longer tied only to trading hours for dollars. Financial independence isn't just for tech billionaires or crypto winners. It starts when your assets earn more in a year than your labor. You'll likely still work, but the terror of, if I lose my job, I lose everything, begins to dissolve. Your portfolio becomes a second income stream that never calls in sick. Around $700,000, an 8% year is $56,000 in growth. You might contribute $18,000 while your money earns over 3 times that. You worked all year. Your portfolio, sitting quietly, out-earned you by a factor of 3. It's not a flex. It's geometry. The curve finally bent in your favor. You stop checking weekly because swings of minus 30 and plus 50,000 are normal noise. None of it is real until you sell. You feel untouchable when your portfolio's bad year still beats your best saving year. You grind a decade to 600,000 by living below your means. Then you buy the dream house, finance the car, and book the big trip. Lifestyle costs jump 40%. Savings fall from 20,000 to 5. You kneecap the exponential phase. You sat on the snowball. The next 300,000 could have taken 4 years. Now it might take 9. Smarter play. Live like you're broke another 3 to 5 years. At 700,000, keep contributing 20,000 a year, and you could hit $1 million in under 4 years. Then a 10% year is 100,000. You could stop contributing and still grow to multi-millions over decades. Beware the urge to get fancy at 7 figures. Pulling cash for rentals often turns passive compounding into an active second job. The boring truth: don't get clever. Let the snowball roll. At 50 with 1.5 million, the math says you're free. A 4% withdrawal is $60,000 a year, inflation adjusted. Many still don't retire, not for math, but identity. The portfolio isn't the constraint. Psychology is. 10 million can't fix an empty life. Build a life outside work in parallel with your portfolio. Automate everything. Invest every payday before you can spend it. Contribute consistently, ignore the noise, and use broad, low-cost index funds. Do not touch the snowball during the push phase. Every dollar withdrawn today forfeits decades of growth. You're not behind. You're exactly where the math says you should be. Build a life you don't need to retire from while the portfolio grows in the background.